earn more money but too busy to start a side hustle? Do it the right way and teach your money to make more money for yourself, even when you're asleep. Dale Corpus will show you just how here on the School of Cash Flow. With his entrepreneurial mindset and extensive experience in real estate and finance, Dale will help you become a responsible, strategic, and passionate passive real estate investor. Learn how you can increase your earnings or find more ways to make money, only here on the School of Cash Flow.
So hello and good morning, everyone. Welcome to the School of Cash Flow. I'm the host, Dale Corpus, and I'm back into the swing of things with my real estate sales business this week. And as you know, I'm a full-time residential realtor. Sales activity has been tremendous this year. And the majority of my home buyer clients are using a leverage to buy a home, which means that they're getting a mortgage to finance the purchase of their home instead of paying all cash. So they put their down payment down, whether it be 10%, 20% down to get a loan from perhaps a big bank or a local mortgage broker. The bank then uses the home as collateral for the loan. The borrower puts some skin in the game because they put some down payment money in the transaction. And the borrower signs a note, with the lender, which is a promise to pay a certain interest rate over a certain period of time to the bank until it's eventually paid off. And so eventually the homeowner may want to sell the home prior to that mortgage term ending, as they want to reap the benefits of the equity and the profit in the home as the home appreciates. Perhaps they want to buy something bigger or whatnot. And, at the close of escrow during that sale, the homeowner, eventually will be paying off the mortgage that they got from the bank. And the entire time the homeowner was making mortgage payments to that lender, that bank was making an income stream off those payments. Again, the bank was making an income stream off the interest that borrower was paying. Now, what if I told you too, that you could act like the bank, effectively be like a bank and make an income stream off someone else's mortgage payments month after month passively? There is definitely a way. And this segues me into my guest for today. His name is Ben Fraser from Aspen Funds, and he helps individuals invest in mortgage notes. They're essentially investing, in debt, which may be newer for some of you, but it's a fascinating way of investing that I'm passionate about because I've been doing it for years. A little bit more about Ben. He is the vice president of finance at Aspen Funds and has helped raise over $50 million in private investment capital from individual and institutional investors for their real estate note funds. And prior to Aspen, Ben was a commercial lender and a commercial credit underwriter, underwriting over $125 million in commercial real estate and business loans. So Ben is a contributor on the Forbes Finance Council, and he is also a co-host of the Invest Like a Billionaire podcast. So without further ado, thanks, Ben, for being on this episode with me.
Thank you, Dale. Glad to be here.
Yeah, well, how are you?
Doing good. It's summer is in full swing, and as you know, with kids, it's busy.
Yeah, very, very busy right now. So from an audience that doesn't know you yet, I'm curious, can you let them know where you based out of?
Yeah, so I'm based in Kansas City, and that's our headquarters as Aspen Funds is in Kansas City here, kind of the heart of the country. And we have satellite offices in a few different places, but that's where most of our staff is.
Okay, so I talked about the word notes. I mean, what are notes? That's not, people might not know what that is. What is a note? Is that a mortgage or what is that?
Yeah, you did a great job teeing me up in your intro. So you make it easy, but yeah, effectively, like you said, a note is a promissory note. It's kind of shorthand for that. And, basically you become the bank. So as an investor, you can invest in these individually. You can invest in them passively through funds like with Aspen. And when you buy a mortgage note, you effectively become the lender, right? And so we all know there's banks on nearly every corner, in most big cities, and intuitively understand that banks are making good money, or else there wouldn't be that many of them. And, it wouldn't be the profession that it is. So it's intuitively people understand it's good to be the bank.
Yeah.
Generally they have the most protections. And when you're signing, your clients that are buying a home and they finance that through a mortgage, they're signing hundreds of pages of these loan documents, and those are generally going to be mostly protecting the bank, right? And so, as you invest in mortgages, a lot of those rights and benefits transfer to you as the lender.
Okay. So what might be different for some folks is that they don't actually own the home at all. They just own the financing, the debt, that was used to acquire the home, correct?
Exactly. Yeah. So it's really similar to any type of debt versus equity investment or security, right? So if you're on the equity side, you generally get the upside potential of any appreciation of that asset. When you're a debt investor, you don't necessarily have the same level of appreciation that comes from it, but generally you're lower on the capital stack, and meaning you're going to be in a more conservative position in that investment. And in this case, the collateral that is backing your mortgage is going to be the home. And so, you can't invest in unsecured debt. And, don't do that if you don't know what you're doing. But like with Aspen and all the notes we buy, and what most investors in this space do, buy notes that are secured by collateral, which are these mortgages and these homes.
Got it. So the way the mortgage notes work, so people could either do it themselves by individual notes, or perhaps invest in a fund, like with something that Aspen has. Can you talk a little bit about the differences of that?
Yeah, sure. And we can get more into it in a little bit, but it's important to differentiate. There's different types of mortgages you can buy, right? And the biggest kind of categories are performing versus non-performing notes.
Okay.
And these two kind of very broad categories have very different investment dynamics around them and kind of return expectations. And so just want to throw that out there so that it's clear what we're going to be talking about in a minute. But yeah, if you want to actively invest, there's actually a very vibrant market for these types of mortgages. There's a lot of investors that have, whether they've been investing in real estate for a while, or this is kind of their entry point into it. It's a unique way to invest in real estate. Okay. Being more secured and being a debt investor. Versus going out and doing a fix and flip model, or holding rentals for cash flow, or whatever the model is. Right. You kind of get a lot of the same benefits, especially as compared to a single family rental portfolio, without a lot of the headaches, right? So if you're the lender, you have a borrower who is the homeowner, and they're responsible for all the maintenance costs to upkeep the property. You don't have to worry about tenants and backfilling vacancies. You don't have to worry about property taxes and insurance. Those are the responsibility of the homeowner. And so from an investor standpoint, it's operationally much more streamlined. Mm-hmm. And generally you're going to have a homeowner who's going to be more invested in the property, and more invested in, making sure that it looks nice, and upkeeping the property, and being on top of all those things. So there's some inherent advantages as if you compare it to other asset classes. But the big disadvantage, if you're an active investor, is it's work, right? And just like any active investment, it requires a certain amount of just knowledge to get into the space. And then, at a certain scale, it's important to have the right licensing. If you invest outside of the state that you live in, every state has different foreclosure laws and different regulations. So it's important to be aware of those. And, because these are consumers and homeowners, there are consumer protection laws you have to be aware of. And so there's certain things that if you're an active investor, it's not something you just, want to jump in and try out investing in notes, as a one-off thing. It's something that you really want to evaluate, make sure it is a path that you want to take, commit some time to invest in gaining the knowledge and the resources necessary, but it can be very lucrative. The other option, and a lot of investors choose this path, and you're one of those, right? Is going to the passive approach, and it's you work with a sponsor like Aspen or someone else that has all the infrastructure, the staff, the track record in a space like this, and leverage their expertise and get a return as a passive investor. In Aspen, we have assets in over 45 states. We're plugged into a federal bank charter, so we get a lot of the licensing that gets pushed through to us. And, we deal with foreclosure in all these states and know all the nuances there. So there's some economies of scale and just basic, knowledge and know-how how to execute on these.
You talked about the two different types of notes, the performing notes and non-performing notes. So assumption is that you guys, you underwrite them differently because they're completely, separate. But can you talk about, how you underwrite these notes to figure out what makes sense? That's what is a good deal?
Yeah, absolutely. And so I'll start with the non-performing notes. It's actually where we started as a firm. And it's a really interesting model. So the whole idea is you go and you're buying a note that is not being paid, right? Non-performing. So the borrower is not paying for some reason. And the niche that we focus on is actually junior liens or junior mortgages or second mortgages, right? Behind a performing senior mortgage. And so it's a kind of niche within a niche, we call it. But, speaking more broadly, the idea with this strategy is you buy a note that's not performing, and you go and work with the borrower to figure out how they can get back on track and not have to worry about getting foreclosed on. And so the whole point is to either get them paying again and get them performing. And if you can season payment stream for 3 to 6 months, you can sell that note back to the secondary market as a performing note, right? To all these retail investors that want performing cash flow. And the yields are still very good when you do that. And then the other is kind of a settlement where they can just take a chunk of cash and pay you off at a discounted amount. And then there's other kind of ancillary strategies and ultimately foreclosure if needed. And it's important to kind of note, which we haven't done yet, but one of the really cool things about mortgage notes that really makes all of this work is discounts, right? So when you're buying a mortgage note, especially a non-performing note, you're buying it at a pretty deep discount. So in our case, when we're buying these second mortgages, we're generally buying them around 30 cents on the dollar. So if a borrower owes us $100,000, we can buy that for around $30,000. And what that does is, one, create a lot of margin for capital protection. But then two, it also creates a lot of leverage and leeway that we're able to work with the borrowers. We can wipe out a lot of debt for them in many cases and still make a good profit. And so for us, that's really important. And we don't foreclose very often. We foreclose less than 2% of the time. So our strategy is to help them stay in the home, get them paying again, and then sell it off as a performing mortgage. So in that kind of a strategy, the returns can be very lucrative, right? If you're buying something at 30 cents on the dollar, we're generally exiting them at about a 2.5x multiple from our cost. So very large gross return. Now at our size and scale, we have a lot of operational costs and legal costs and other things that it takes to generate those returns, but it can be very lucrative, right? And especially if you have some IRA money and you want to try it out, that there's some ways to do that. But it's also very difficult as a retail investor to get access to the types of notes that we're able to buy. So that's one other kind of disadvantage actively, unless you're kind of in the network. But that's kind of the non-performing notes. And then performing, it's a very different strategy, right? Where you're looking for a cash flow stream. And so a lot of people think, hey, the best place to do it is building a rental portfolio. Well, it's difficult to do, especially where you are and on the coast, and where there's not great price to rent ratios, or it's more difficult to make the numbers work. But it's getting increasingly hard anywhere. You see all these headlines of a lot of big institutional investors are flooding money into the single family rental space. And so it's driving down cap rates. It's making the spreads even smaller. And so another great way to build passive cash flow is through mortgage notes. And so what we're doing is we're buying a performing mortgage at a discount. And so a lot of people think, well, why would someone sell a performing mortgage at a discount? Well, we're buying these generally from larger banks or institutions. And the way that the banks are regulated is it's a lost opportunity cost for them to hold on to these. So what happens in kind of the whole life cycle here is a borrower gets into some financial challenge at some point along the payment stream of the original mortgage that they took out, right? And it's generally something temporary, something like a job loss, a medical crisis, a divorce, but something that's very disruptive and kind of cause them to not make their payments current. And so they go back to the bank to renegotiate terms because they want to stay in the home. So they come to an agreement, they start paying again. So now they're back on track, right? So it's performing. But the issue is from a banking standpoint, and from my background being a banker, saw this firsthand, is at that point, they have to classify that loan differently on their balance sheet. And the regulators penalize them for having too much of this on their balance sheet, right? So one, it's, if you know how banks make their money, is they have to lend against their capital. And when they have a loan that's risk rated higher, they can't lend out as much capital. And so it's a lost opportunity cost for them. And then secondly, banks are not generally in the business of wanting to take back collateral, right? If a loan goes bad and it goes to the workout department, that's not a good thing, and it's not a profit center for them. For us at Aspen, and if you do this yourself and you do it right, taking back the collateral is actually a profit center for us. On the handful of loans that have defaulted in that portfolio over the past 8+ years, we've actually made a profit on average when we have to take a loan back, right? Because of the discount. And so that's again why the discounts make sense. But the other cool thing with the discounts is it makes our yield pretty high because even though the borrower may only have a stated interest rate of 5, 6, 7%, because of our discount, it makes our yield a lot higher, and we can pay out a pretty nice return to investors on a passive income basis.
Got it. Makes sense. When you guys are looking for notes as investments, is there a difference whether or not the borrower actually lives in that property or not? Mm-hmm.
Yeah. So, there's a lot of, hard money loans. I'm sure you're very familiar with those, and your listeners probably are as well. Those are generally loans to investors, right? And a lot of times bridge lending for buying a property to fix it up and then flip it out, or to go into permanent financing. And it's kind of that in-between financing while they're doing the improvements to the property. And they have pretty good yields too. It's another form of debt that is, a nice cash flow, pretty good yields. Yeah. The challenge in that business is it's inherently cyclical, right? So when the economy is booming and when construction is booming, that business does very well. But when that turns and construction gets hit, like it did in 2008, 2009, right? That type of business struggles because investors are not as, they're much more business minded, right? Profit minded. And if there's no more profit to be had in a particular project, they're going to hand the keys back to the lender, right? And then it's the lender's issue to have to go and, perfect in their collateral. Right. Well, in our case, we almost exclusively buy notes where the borrowers are homeowners. Okay. And the reason we like that is something we call emotional equity. Okay. And it's not a tangible thing, but it's something that is very, very powerful. And we've seen it over and over and over again where the financial numbers may not make sense, from the outside looking in, but this is the home where they grew up. This is the neighborhood that they grew up in. This is where the kids go to school. This is where they have a job that they can't easily relocate for. And so there's other factors going on. And then talk about all the social pressures, right, of being foreclosed on. People don't want that. And so, we see a very high performance rate and a very low foreclosure rate on average, because most people in these scenarios want to stay in their homes. And we, in one of our presentations, we have some data we pulled from the New York Fed that did a survey a few years back. This is kind of after the last real estate crisis. And they surveyed a whole bunch of borrowers and homeowners and said, why do you keep paying your mortgage if your home is underwater, right? Meaning if the value of your home is worth less than all the debt that you owe on it. Right. Intuitively we think, well, that doesn't make sense, right? But just because your home drops in value doesn't mean you're going to stop making your mortgage payment, right? You still have to have a place to live.
Right.
And the number one reason by a long shot in this survey was, I like my home and I want to keep it. It was a purely emotional reason for why they kept paying in these situations. So that's something we look at. Another kind of underwriting hack, if you want to call it that we look at when we're buying these performing notes is the comparable market rents. So what we want is when our all-in payment with our borrowers of their principal, interest, taxes, and insurance is equivalent to or less than the market rent for a similar type property in that market. And what that does is create this kind of buffer and stickiness factor for a borrower they're going to keep paying, because if the switching costs to move into another property that they'd have to rent is going to be more, then they're just going to keep paying. They're going to keep paying their mortgage. And so that's been another kind of factor we look at when we're underwriting these.
Yeah, that definitely makes sense. I mean, it's what I find that's really interesting in notes versus people that are flippers. Flippers, they rehab the property, but like the way you're talking is that in notes, you're really working with that borrower, and the first step is really just to keep in that house, and you're really like rehabbing the borrower, trying to make sure they can stay there, right, and making it very worthwhile for them to stay. Since if they didn't stay, they'd probably be paying more in rent than they would by just staying in the home, right?
Absolutely. Yep.
Regarding, performing notes and non-performing notes, like the yields on the two of them, they're different. So can you talk a little bit about like that? Like what's the difference in expectation for yields between the two?
Yeah. So if it's a performing note, yields are going to range depending on if it's a first mortgage or a second mortgage, right? So we buy both first and seconds in our performing note funds. Okay. And the yields on a gross basis are going to be anywhere from kind of 10 to 15%, right? And so if you're an active investor or you're going to do this yourself, those are some of the yields you can expect, and it's pretty great, right, for passive cash flow.
Absolutely.
For our fund standpoint, we have all the management of those assets, and it's a diversified portfolio. So we pay our investors a 9% preferred return. Okay. That's paid out on a monthly basis. And then the non-performing notes. So there's kind of two big categories there. It's the first mortgages and the second mortgages in the non-performing category. So we focus on the second mortgage space. We'll probably be getting into the first mortgage space here down the road, but the discounts are so much greater on the seconds that the margin is so much better. And so it's really kind of where we've carved out a great niche and have a great product there. But the yields there, I mean, on a net basis to our investors, we're usually targeting at least 15 to 20% annualized return, and we try to beat that in our funds when we are doing those funds.
Okay, so the idea of investing in non-performing junior lien it's really a unique niche. I mean, it's very particular. For example, the Aspen, since that's like almost like the bread and butter. How did you guys come across that niche, since not many people are talking about that?
Yeah. So kind of the whole origin story of Aspen started with our two co-founders, Jim Afficcio and Bob Fraser.
Uh-huh.
And in Jim's background was he's been a 30-year real estate veteran, right? He's been, in all over the real estate map as far as, ways that he's been involved in it. And for most of his career, he was a developer, a real estate developer for residential developments on the West Coast. And he was doing really well, like a lot of people were back in, 06, 07. And then the last crash happened and, he was doing a lot of spec builds. Well, that market completely evaporated. Yep. And he was using a lot of hard money at that point. And so he was working with his hard money lenders and working on these properties and, just headache after headache. And, the light bulb moment kind of occurred to him. Hey, it's, the lenders seem to come out with a lot less scars than the borrowers when things turn poorly. And so that kind of was the initial spark that led him on the journey, and then discovered real estate note investing, and then kind of this junior lien investment strategy. And so he presented it to Bob, who was just kind of a recent acquaintance who's also my father. Uh-huh. And Bob has kind of a background in finance and tech and raising capital. So they kind of raised their first fund just from friends and family to kind of beta test this strategy. Yep. And ended up returning, I think the net IRR was about 24% in that first fund. Right. And that was just really with the two of them and one other employee working this out. And, now we've kind of grown quite a bit, but that was really the whole genesis of it. And we've continued to grow into the space. And, as we've gotten larger, we get access to more and more opportunities. So we're generally buying, direct from larger institutions or, one step removed from those institutions. And so it's kind of allowed us to keep scaling with the same strategy. But to your question on why does this strategy make sense, it's pretty similar in the sense of, the emotional equity has a big play in this, but we target junior liens that are not being paid behind senior liens that are being paid. And so this is kind of a weird, situation probably for all your listeners who probably have great credit and make a lot of money. And, why would someone not pay their second mortgage? Well, a similar deal where a borrower gets into a financial challenge and they want to stay in the home. Well, they'll stop paying their second mortgage, but keep paying the first with the assumption that the second position lender would not foreclose. Right. And that's generally going to be true. Those second position lenders, it's a lot more difficult. And a lot of times they don't know how to foreclose from second. They assume you have to pay off, the first mortgage, right, which is not true in a lot of states. And then again, it's just a loss recovery at that point, right? Because if it's been charged off, a lot of times it goes from, current to non-accrual status to charged off. And so from the bank standpoint, they've actually charged off a lot of these assets on their balance sheets. And what that means is they've written the value of these notes down to zero or near zero. And so when they're selling these, it's actually a profit for them based on what they already wrote the value of the loan down to. So it's actually a gain on sale of an asset. So it's actually good for them, right, to get rid of these because we'll actually pay something for it, and it cleans up their balance sheets. But then when we're working with borrowers, when they're paying their first mortgage, we know a few things intuitively and right away. Is one, they want to stay in the home, or they want still be paying the first mortgage. Right. Two, we know the home is occupied. And three, they have an income stream, right? There's some way that they're making the payments. And so a lot of times what was the initial trigger for them to stop paying the second gets remediated, and we can work out a deal with them again, right? Let's figure out what you can pay. Let's get a financial package here. Let's, maybe pull from your 401k. Let's talk to a family member, get a loan, and just pay us off, and we'll wipe out debt for you. Or if your credit has improved and there's enough equity in the home, then you can refinance and do a loan consolidation and take us out. Or if they don't want to work with us, we will foreclose. And That again doesn't happen very often, but it's basically the protection that we have as a lender. So that's kind of the whole idea there. It's really we call it a velocity model, where we go and purchase these assets in mass, and then want to work out a solution with the borrowers on relatively short time frame, and then we can replenish our capital and go and buy more.
That makes sense. Going back to where you were talking about discounting when you buy non-performing mortgage notes, I have a related question on that. It's like, how do you determine how much discount you can get? How do you determine what's a fair value?
Yeah, good questions. Getting in the weeds here. I like it. It's a great question, and something that is, an inherent challenge in a space like ours that is what I would kind of call a less liquid market. There's not an active market like the stock exchange, right? That instantly every second what the price is for this asset.
Yeah.
But because of that, it actually creates a lot of opportunity for us, because there is a lot of what I call pricing arbitrage or mismatch of the intrinsic value of these assets versus what the market is willing to sell them at.
Yep.
That creates the big gap here. And part of the other challenge in that strategy specifically is, at Aspen, we kind of fill this gap of a middle market investment firm to where the junior lien space is too small for the big institutions to come play in the sandbox, right? Because they're looking for, the spaces that end with B's, with billions, right? And this is, millions and hundreds of millions if we can get to that size in the strategy, but it's limited. And then to also operate at our size, we have a lot of compliance, regulation, and licensing that we've spent, a lot of money investing to get to the place that we are at. So it prevents a lot of, newbie, more retail mom and pop investors coming into that space. So it creates this inherent gap in pricing. But specifically to your question on fair market value, we underwrite to a variety of factors, and some of the most common are, the number one factor in this space on the non-performing side is how much equity is there in a property, right? Mm-hmm. Because that's going to dramatically impact the strategies that we can work with the borrowers, right? If we have a real deep equity note where there's a lot of equity above the first mortgage that fully covers our position and then some, where we have margin if the real estate market crashes, well, we can use a lot of leverage to make a good solution with the borrower there, right? Because ultimately, if they don't work with us, we just foreclose and we're going to get fully paid off. And so, a lot of times we'll use it as a means to an end of just a good conversation with the borrower. But if there's less equity, then it limits what we can do, and it limits the risk that we're willing to take on that. So we'll price that much more on a lower price per principal balance is kind of the metric there we use, but it'd be a lot lower. We'll have to pay a lot less for that because we're more limited in the strategies we can use with the borrowers. Though historically we make a lot of money on the ones that are even negative equity to minimal equity. We don't have a lot of those, but that is a portion of how we underwrite those. And then the other big factor is the state that it's in. So there's kind of a big gap between judicial foreclosure states and non-judicial foreclosure states. And really what all that means is, how lengthy is the foreclosure process going to be in a particular state? And so there's certain states that, we know what the process is because we've been through it, and we will significantly discount the price on that particular asset because we know, hey, it can take up to 3 years to complete a foreclosure in, Upper East Coast states. So it's something that we have to price in to our model. So those are the real big underwriting factors.
I have a question as it relates to liquidity. Like, how liquid or illiquid are the investments in your mortgage note funds? Is there a minimum time frame that investors should have and as an expectation to stay in that fund, for example?
Yeah. So our we have our two strategies, right? Which is performing notes and then non-performing notes. So the non-performing notes, we raise those in closed-end funds, meaning we go raise the capital from investors, we deploy it into the assets, and then over about a 3 to 4 year time frame, we work out those assets, all the assets in the fund until there's nothing left. And over the course of that time frame, we're returning principal and profit back to investors. So those are usually a 4 to 5 year fund time horizon. And then on the performing note side, we have an income fund, and it's pretty unique because it's an open-end fund. And so this is pretty uncommon in the kind of private equity real estate investing world, where we actually allow liquidity after 1 year. So we have a 1 year lockup, and then with 90 days notice, we have a liquidity provision where you can request a portion or all of your funds out of that fund. So that's, it's not a guaranteed thing, but we've never missed it up to this point. And it's, we've got a lot of levers we can kind of manipulate to generate that. And so that's a pretty cool feature of that. And part of the reason is the performing notes there's a very strong appetite for those types of assets, because cash flow and passive income is hard to find, right? And so there's an inherent appetite for those.
Yep. Does Aspen also work as like the loan servicer too? I mean, how does like loan servicing work with all these, performing, non-performing notes that you guys have?
Yeah. So the whole servicing side of the business, it's not something that we've got into or really plan to get into. It's very compliance heavy, and it's very low margin. And the cool thing is there's a lot of third-party servicers that do a great job. And we work with them, and it's pretty minimal cost on a per asset basis. But the servicers we work with are generally sending out the borrower statements, sending out different types of communications to the borrowers on our behalf, and they will collect payments from the borrowers and then remit them to us.
And then in terms of like, you talked about different states having judicial, non-judicial types of foreclosure laws. Where geographically do you guys focus where you buy notes? Is it all over, or is there specific regions?
Yeah, so we buy all over. Like I mentioned earlier, we have assets in 45 states, so we're pretty well diversified. There's not states that we hardline don't buy in, right? There's some that we're pretty close to that line on where we really don't like them. But part of the challenge is, you kind of have to take what the market's giving as far as, what are the banks selling? A lot of times they're selling these in larger packages, and they're liquidating a portion of their portfolio. So kind of how we get around maybe a particular state or area we don't like as much is we'll just apply heavier discounts to those. So the cool thing in this business, we can underwrite these individually. So even if we buy, a package of notes together, we underwrite them and price them individually, so that we kind of have a sense of what we need to achieve on that particular asset to hit our internal benchmarks. But we're definitely looking at certain states that, if it's going to be in, New York, New Jersey, other East Coast states, we're going to discount those pretty heavily. Surprisingly, California is actually a fast foreclosure state, or relatively fast, and it's pretty decent from a lender standpoint. And then a lot of the Midwest and southern states aren't too bad to deal with, but it's you'd be surprised some of the states that are pretty challenging. So it's something to be aware of. And again, you have to price that in, or else you have to price in your hold time and your hold period for foreclosure into your model.
Because investing in notes is like just a lesser known way of investing that is not familiar to many people. I mean, is there like a certain amount of education for somebody that wanted to invest notes passively that you'd want them to have before they decided to move forward on an investment of even at Aspen?
Yeah, definitely. I mean, first and foremost, we're restricted per just the Securities and Exchange Commission that we can only work with accredited investors. And basically that's just a proxy for, how much risk can a particular investor withstand in their portfolio. And obviously the more net worth you have or higher income you are, the less, the more you'll be able to withstand kind of a shock to your investment portfolio. So that's kind of the first, gate that we have to look at before we can go the next step. But then, we work with a lot of, real estate investors that have been investing in other asset classes like multifamily, like self-storage, affordable housing, or, different development type deals. And they see notes as a really complementary portion to their portfolio, right? Because it has some inherent advantages, especially the income strategy that we have liquidity plus a high yield we're paying out monthly. So we have a lot of investors that use this to kind of supplement their passive income. And we also work with a lot of investors that are kind of getting new exposure to these types of alternative investments. And so there's I'd say a bigger education process with them getting comfortable with the strategy, with the portfolio, and, just are we actually being nice to our borrowers, or are we kicking them all out and taking the properties back, right? There's definitely some levels of investigation. And, we only want to work with people that feel very confident in what we're doing, in particular. But I would say just in general, it's important to know what you're investing in, at least at a pretty basic level, right? And, one of, a well-known Warren Buffett quote is invest in what you know, right? Effectively, it's, don't invest in what you don't know. And it's shiny object syndrome, where you hear about the latest investing craze or trend, and it's also going to jump into that. But, what's the actual utility? What's the actual inherent value? What's the actual strategy and how are they generating, profits in that model? And so it's important to understand, just at a high level, what you're investing in. And then a lot of investors with us, they start small, right? They kind of, I'll call it, dip the toe in the water and just see what's the temperature like. Do I like working with these people? And that's advice I would give to any newer investor stepping into these types of investments is, start small and just build the relationship. For us, we're very long-term focused and relationship focused. So we're okay if an investor starts with our minimum, and most of our investors invest more with us over time. And so it takes time. It's that kind of trust building process. Right. And we send out pretty comprehensive investor reports every quarter. And so it's another great way just to get educated on the strategy and what we're doing, how the portfolio is performing. But I would say just in a general way, education is very, very important. You've worked very hard to earn your money, so you should work as hard or harder, in my opinion, protecting that and growing that. And I feel like a lot of investors don't do that because they've been conditioned to just set it and forget it. Just put it in the stock market and don't think about it. My financial advisor will tell me how much I need when I need it. And it's like that's not a good approach, right? If you want a financially independent lifestyle, or you want passive income, or you want to know where you're at. Can
we talk about COVID a little bit? I'm curious to know, have you seen a lot of issues in the performance of notes, since COVID? I mean, some people in some states haven't been able to make their mortgage payments. Like, how has that affected, the business? Like, how has it affected the funds?
Yeah, I'll break that question down by the strategy because it affected them differently. So in the performing note strategy, we didn't really have a great sense of what it was going to be, right? Of how much our borrowers would stop paying or be impacted in their payments. Yeah. And, in our model, we underwrite to a 30% default rate or delinquency rate. Okay. So that we feel we can keep paying our investors, even with a pretty substantial delinquency in the portfolio. We only really generally see about a 5% plus, rate of delinquency on any given time. So it's, we have a lot of margin there that we can withstand. Okay. But what we actually saw was an initial little dip, right? And then pretty quickly, our borrowers were paying in full. And we actually, over the last 12 months, collected just under 100% of our scheduled payments from our borrowers. Yep. So it's pretty incredible. And on the flip side of that, in that fund, because we're buying these at a discount, when a borrower pays us off through a refinance or a sale of a property, and as you know, rates are super low and there's been a huge boom in refinances, it's actually a profit for us. So we've had a lot of refinances that have added additional income. So that particular fund has actually performed the best it's ever performed, ironically, right?
Wow.
And part of that's the strategy. Part of it is we've built out a pretty good model. We've are glad that it proved well through that kind of storm there. On the non-performing note side, it's a little bit different, right? Because there is no payment stream initially. We have to go generate an exit with borrowers. So it's kind of been this big divergence of, some borrowers that were already okay, and then a lot of the stimulus money I think helped just get people, across the finish line, and we're able to generate some great exits. And then other ones, especially ones that are in deep equity, where we will kind of nudge people with a foreclosure notice,
right.
Notice of default, with this kind of like, hey, we're heading to a foreclosure unless we deal with this, right? And again, that happens fairly frequently, but we rarely ever complete that. So it's really just a means to have a meaningful conversation, right? Right. But the issue is a lot of the states shut down their foreclosure offices, right? And they weren't doing foreclosures, and there's still states that it's all still pending. Right. So we have a lot of notes that are kind of in these pending foreclosure status that we're just waiting on, right? And so it's kind of waiting game, but it's not I would say a fundamental issue of return profile. Is just kind of delaying, by a few months usually in these scenarios where we're kind of waiting on that. So that's kind of probably the biggest impact. But again, I mean, in our minds, when we're working these out, we just move on to the next one, right? And put that one kind of in wait until it's ready mode, and then work on the next one that's ready to work. And so we have thousands of assets, so we're not twiddling our thumbs by any means.
Makes sense. Any advice that you would give to somebody looking to invest passively in the note space?
Yeah. So passively, meaning working with a sponsor like us, I would definitely say track record is number one. Right. I think a lot of investors can overcomplicate, how do I know if this is the right sponsor to work with? How do I know if this is the right strategy to work with? I think one, intuition is pretty good. It's not a perfect measure by any means, but it's usually you get a pretty good intuition. And then the kind of tangible stuff is, what's the track record? How have they done in the last deals? How have they done in the performance of their funds in our case? Or how long have they been around? And just all the really basic important questions, right? Because it's past performance isn't necessarily indicative of future performance, right? I always got to say that, but it's a pretty darn good indication, right? And then I think looking at the management team, what are the backgrounds of the key managers and the folks that are operating that strategy? Feel good about that. I think incentive structure is really important. So, we're very transparent with the fees that we charge and kind of the way that the waterfall set up for how our investors get paid. And it's important to understand that, because there are strategies and sponsors that may be very fee heavy or will make their money on fees and other things and not be incentivized to generate a good profit for investors because they get paid on the front end, not the back end, right? So that's really important. The other thing that is kind of I think a lesser known thing that it's really important to me. And I think it's a really good indication of what you can expect going forward, is looking at the sponsors and investor reporting. Mm-hmm. So what type of reports are they sending out, and how frequently are they doing that? For Aspen, we try to be very communicative. So we send out very detailed quarterly reports. Mm-hmm. We send out quarterly financial statements. We send out, an investor statement of account to know exactly where they're at with their capital and the profits they've been earning. We do, annual shareholder meetings and other kind of spontaneous webinars and other things. So, get a sense on the front end before you invest of, hey, send me all your last year's reports. I want to read through those. And how transparent are they being? Right. And what did they say a year ago in that report? And how has that transpired? Right. I mean, it's a really great way. They can tell you one thing, but then actually go and see what they said. And did that happen? Were they conservative? Were they not conservative? So I feel like some of those just really basic things can give you a really good inclination. And then just, again, start small and grow over time. It's good to have diversification and kind of build with the ones that you really like to build with as they've proved themselves.
Makes sense to me. Ben, how can someone learn about you and your company?
Yeah, Aspen Funds. So if you go to aspenfunds.us, you can kind of learn all about the current offerings that we have available. We have a lot of education there. We have a lot of free resources. So I put together one recently that's basically all about mortgage note investing, mostly on the performing note side, but it's called the Mortgage Note Investing Guide. If you go under our resources tab, you can download that. We're about to launch our podcast called Invest Like a Billionaire, which will be launched here in the next few weeks. And it's basically just education around alternative investments like our strategy with real estate notes. And just one of the big focuses we're going to be doing is focusing on interviewing other successful passive investors and, what's worked for them, what has not worked for them, what strategies do they like, what do they not like. And so those are the kind of things that we want to help just educate people, build relationships with investors. And but that's the best place to start is our website.
Perfect. And what's the best way for somebody in the audience if they had further questions? What's the best way for them to reach out to you?
Yeah, it's pretty simple. If you go to our website, there's a big button that says contact us. If you put a little note in there, it goes directly to me. So I'll see that and
get everything.
So it's pretty easy.
Well, those are all the questions I had for this episode. So if any of you listeners have any more questions for Ben, feel free to reach out to him through the Aspen website. Thanks, Ben, again. For coming on this episode. Thanks for your time and all the value you provided my listeners about mortgage notes today. And to my listeners, thank you very much for checking out this episode of the School of Cash Flow. So until next time, live life abundantly.
Thanks for listening to another episode of the School of Cash Flow. We hope you enjoyed our deep dive into all the tips and tricks you can use to help you on your passive investing journey. In the meantime, you may visit www.cashflowschoolpodcast.com for more great episodes. Don't forget to subscribe, rate, review, and share. That's all for this episode, folks. See you next time.